Let's chat about futures in focus after that weekend expected jobs report. Not enough to change the recent trend for gold. Futures of the precious metal pairing declines. Wage growth stalled, calling into question the Fed's plan to step up the pace of its rate hikes. Joining us now from the CME, Brian Battle, Performance Trust Capital Director of Trading. Brian, are we still on for that December rate hike, or has anything changed?
Yeah, I think we're still on. I heard Diane earlier, and she's right. That is a foregone conclusion. That's Janet Yellen's swan song. The new guy doesn't interrupt the old guy, so we're going to get a rate increase. So there doesn't seem to be any effect there. And the bond market is avoiding that also. You know, everybody has their opinion, but I'd always look at empirical data and look what the markets are telling us instead of opinion.
And the markets didn't seem to react too much to Jay Powell. What are the feelings down there?
Yeah, I think Jerome Powell is the safe choice. I think he is going to be the guy that we had a 246 10-year about a week ago when it looked like, well, maybe they're not going to pick Powell. Maybe it'll be Walsh, maybe somebody else. And the 10-year Treasury has rallied 10 basis points. We're down to a 235 right now because there's some comfort that it's going to be the same as usual. There's going to be no change. So the Federal Reserve is going to keep ratcheting up short interest rates, and that is pushing down long rates. So the market is telling you they don't have any fear of growth or inflation, and the yield curve's getting flatter. 10-year Treasury being low, is the market is signaling they have no fear of inflation.
So the yield stays below that key 2.4% level?
We're 235 right now. 230 seems to be the resistance level there on the downside. So watch 230 and also 245 on the high side, which we touched last week. So the market voted confidence for Jerome Powell as business as usual. He's Janet Yellen Part 2.
As you say, Brian, little evidence of inflation. What's going to make gold go higher?
So gold is a store of value, right? It's a currency, so it has a medium of exchange and it's a store of value. Gold is selling off for two reasons. One, the global macro threats have diminished. South Korea isn't in the headlines anymore, or North Korea is not in the headlines anymore. They're not shooting any rockets. Spain is still one country. So the fear factor of buying gold is kind of out of the market. That's diffused. And the thing we just talked about, there's really no fear of inflation. So the reason to own gold is diminished. So we're going to have this slower grinding price in gold. We're about in the middle of the range. So no news on gold. And there doesn't seem to be anything running it higher other than, man, there's going to be a lot of inflation, or holy cow, the world's getting dangerous again. That'll put the speculative bid back into gold.
Brian, oil's ascendancy continues, highest since July 2015, $54.73. What are the key levels? I mean, could we go to 60, or is that just too much?
It seems like a long way from here. In oil, the thing that's driving oil is not demand. We know the global economy is getting a little bit better, but there's not this giant acceleration in demand for oil. The thing that's running oil prices right now is supply. And so the supply, oil is starting to rally because of supply concerns. First is Venezuela is falling apart, so they are a large supplier of oil to the market, so we're a little tenuous about what's happening there. But OPEC, probably more importantly in the short term, I don't know if we can believe them, OPEC has said we're going to keep our caps. We're going to not produce as much oil as usual. So you can believe OPEC that they will keep everything under control. Saudi Arabia and Iraq have promised that they're going to keep the cap under control. I don't think you can't believe OPEC. Everybody cheats, and there are a lot of guys that aren't, a lot of countries that aren't in OPEC. So this is a temporary, I think, run up in oil here based on what's going on in Venezuela. 60 seems a long stretch. There would have to be real, consistent diminishment in supply. And once you start getting closer to 60, there's more suppliers come on market. The U.S. starts pumping more. The marginal manufacturers start producing more. 60 seems really high part of the range. We're kind of at a high point right now. We'll have to see if we break through 55, but 60 seems a really long way given the supply-demand balances in the world right now.